Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. What's going on the past couple days? Well, I think the mortgage rate scenario is forefront in all of the news for housing these days. Let's get right into it. By the way, if you're not already a subscriber, please help my channel grow. Click the subscribe button on the bottom right of the video. I'd certainly appreciate that. Thank you. So here's the scoop. So mortgage rates have fallen to a near 50-year low. This is, I guess you say, the taglines or the headlines for all these articles that are going out. The average rate for a 30-year fixed rate mortgage fell to a historic low 3.29%, according to Freddie Mac's primary mortgage market survey. This is the lowest rate in the survey's almost 50-year history. And meanwhile, of course, mortgage applications increased 10% from last week, from 1 year ago, and is showing no signs of slowing down. Now, according to MBA, which is a mortgage business association, reported mortgage applications rose 15.1% for the week ending February 28th from the prior week. And according to the report, and this is really interesting, the refinance index increased 26% from the previous week and was 224% higher than the same week this time last year. So clearly everyone's taking advantage of the rates to do what? Refinance, either rate and term, lower your payments, or take money out at such a great low interest rate here. The purchase index, however, dropped 3% from the prior week. So when rates are low, and we hear this from time to time, is that it's almost like when rates drop, somebody does an analysis on all the mortgages or property values and borrowers out there, and they basically say, hey, when it drops, half a point or quarter point, whatever, we now increase, the capacity of who could possibly benefit from a refinance. I think we're something around 11 or 12 million now. So this last sort of, I guess you could say, rate decrease has sort of, said, hey, there's 12 million borrowers or potential borrowers across the nation that could benefit from this. Comfortably they could refinance and they would benefit from the rate decrease, and there's room with loan to value in their property and things like that. So just sometimes keep your ear open for that one. So again, this is the lowest level in more than 7 years, and obviously amidst increasing concerns of the economic impact, and of course, reason being it's the coronavirus. That's of course what we hear about in the news all the time nowadays. Basically, that's causing financial market volatility, which then is causing rates to adjust and go lower. So this is what is sort of the a net result of all that. So that's what we're hearing right now. The big news again, refinance applications surging over 200% from this time last year. 30-year fixed rate mortgage dropped its lowest level in more than 7 weeks. More than 7 years last week. So this is what you're going to find in the majority of the news out there on housing. Clearly, we've mentioned this before. It'll be spun with respect to the lower interest rate. It means lower payments, which means your purchasing power has increased. So go out and buy that expensive property. That's what the lenders would like to see you do, and it's up to you whether you want to roll the dice and do that. Just so we're clear, I'm not advocating you buy or do anything. I'm just reporting the news. Clearly, people will take this as a sign that they can go out and buy, or that maybe they want to shift up, or that property that could have been out of reach for them financially is now more in reach now. Good for you. Do what you need to do. Just realize that when real estate groups and other, we'll call it I guess you could say real estate, whether it's mortgage people or title people or CoreLogic, whoever is reporting on this, saying that things are more affordable, it's your payment is more affordable. The property prices have not decreased in that capacity. All right, so don't expect interest rates on a 30-year mortgage to fall below 3%. So this is an interview with the Quicken Loans CEO, and basically his kind of perspective was good news or bad news. Certainty about what's going to happen, I believe, will cause interest rates to rise. So he's actually kind of saying here that, we're getting some benefit of some very low rates right now, but don't think they're going to keep going down. There's a floor limit as to what the mortgage companies are going to do. We're at, historic lows right now. He doesn't see them going any lower. He actually says when we have some I guess you could say the volatility have subsided a little bit in the markets, and with what's going on in the world right now, he expects we're going to see rates kick back up again. He said, if I were a betting man, I'd say there's a higher probability rates will rise in the next few weeks rather than go down. So just keep that in mind if you're looking again to refinance or purchase a house. Now, to tie in with that, mortgage rates are lower than ever, but are lenders keeping them from going even lower? This I found was an interesting article, because what is going on right now in mortgage world, so I'm sure if you work for a lender or you're involved in the processing of mortgages, you're seeing an influx of applications, influx of activity, etc. So really, what they're saying in this article, and I'll post this in the information section of the video, is the fact that some lenders are trying to protect themselves from being crushed by the demand. And this time last year, we heard and we saw in the news that lenders were actually letting people go because they didn't have the demand. So they were laying people off, etc. Well, now the demand is huge compared to this time last year. They don't have the staff, so they're trying to hire more people, and it's taking longer for them to process their loans. It's the nature of the ball game here. So they are trying to protect themselves from being crushed by the demand. And the term that several used in this phenomena is throttling. So with lenders keeping rates above where they could be to ensure that they can fulfill business they are getting. So if it drops too low, they're going to have such a surge in the demand that they're not going to process the demand, or they're going to have to keep their rate locks open for a lot longer. And that's something too, is saying several lenders share that they've heard other lenders having to extend their lock windows to as much as 180 days because they're concerned they're not able to close with these new loans for as much as 6 months. So what a rate lock is if you apply for a loan today and you're in process, say, to purchase a house or refinance, a rate lock really is the lender guarantees that the rate won't go above a certain value. So you're locking that rate. Now, whether it decreases, there may be some movement having even a lower rate, but typically what they're saying is they're locking the rates in for today, saying if it takes us 30, 60 days to close on this refinance or purchase mortgage, the rates, even though rates may go up in the environment in the marketplace, your rate locks, you can't go over a certain limit. So, which is great, but normally, that's a 6-month rate lock, so that's pretty aggressive for them to saying, hey, and I guess the prediction is they're going to have this much volume. It just may take a lot of time to get through all these refinances, etc. So I just find that's interesting. So that's what's going on. So the most of the information we're hearing these days is particularly associated with interest rates, clearly, with the economy and coronavirus and how it's reflecting in the marketplace. Again, what do we see? Will this continue to prop up housing values? I'm pretty sure it will. It just depends on how long this is going to go on for. So that's the scoop on that. Now to sort of put that to bed, Adam Data Solutions came out with their end of the year, so 2019 year-end home flipping report, and I found it quite interesting actually to read this, because it sort of shows where the real estate market is headed, what's going on, and sort of what to me is a precursor to the future. And as I've always said, it's the feet on the street that actually see the trends and realize what's going on a little sooner than the normal people in society here. So if you're a retail buyer, you're not going to know what's going on in the marketplace till after it's already happening and the market's adjusting. Whereas people who are working in the market these days, doing deals right now, today, etc., and I don't mean necessarily retail deals, I'm talking more off-market stuff, pure real estate investment, they're seeing the trends, they're seeing how it's hashing out in the field, and they're going to understand what's going on and adjust their business prior to sort of flowing through to the retail normal home buying market. So anyway, so this past week, Adam released his 2019 year-end home flipping, I guess you could say home flipping report, and it shows that almost 246,000 homes were flipped in 2019. Which is huge. So it's up 2% from last year, and that's the highest point since 2006. So we've really seen, 2006, July 2006 was our peak with respect to values in Shiller. So, that was the peak, and then of course it dropped, and now it's actually gone 2% above that peak in 2006. So kind of like, I talked with Shiller, how we're 15+% above the current national index versus 2006's peak. Well, now our flipping volume has surpassed the 2006 peak as well. So I think that's an interesting correlation personally. So the number of homes flipped in 2019 represents 6.2% of all home sales in the nation during the year, an 8-year high. That's up from 5.8% last year. So flipping activity increases, but what has actually not increased is that the gross profit, gross return on investment. So that's continued to drop over the past couple of years. So typically homes in 2019 generated a gross profit of $62,900 nationwide, which was down 3.2% from the previous year, 2018, and down 6% from the post-recession peak of 2017. So it kind of, your flipping income peaked in 2017 about 67,900, or 66,900, and we're down to about I guess you could say almost about $4 to $5 grand from that peak. Now, it doesn't seem like much, but it certainly is a trend. And so what we're seeing as more participants in the marketplace, we're seeing more homes being flipped, but we're seeing some of the gross profit eroding. And remember, gross profit is what I bought it for, what I sold it for. It does not include cost of holding costs, finance costs, rehab costs, etc., sales costs, if there's commissions paid, closing costs, whatever. So this is just a gross. What you actually net to me really is, it boils down to, speed of flipping, or is it your own cash, is it your borrowing money, things like that. So there's a lot of things that go into the net profitability, but just on the gross side, we're seeing that general margin erode over the past couple of years. So that is something to keep in mind. Now, excuse me, again, lots of pollen in our area these days. I'm still coughing with that. So something I do want to mention here, what I thought was very interesting, and it never really has come out until this, I've seen it now here. It says, for last year, so for 2019, the year-over-year increase in lis pendens filings in this space was greater than 50%. So just to step back here, what are lis pendens filing? Well, lis pendens is the Latin nomenclature for, I guess, notice of litigation. So lis pendens really is a foreclosure filing. So one of the things when we have a increase in investor activity, an increase in house flipping, is we have an increase in the casualties that come along with that. So you could jump in, get financing. I can tell you these days, compared to the last housing crisis, where we are today, there is a whack ton more of, I guess you could say, private investors who will lend money. Groups you can go to that will lend money for fix and flip projects, for rental, rental accommodation if you want to be a landlord, stuff like that. So there's a ton more money available, not just through private lenders, but through other lending groups as well too. A lot more of these programs out there. There's tons, all right? So if you're looking to be an investor, you've got more flexibility instead of just using your own money these days, or going to more traditional sources, which your loan to values are going to be much lower, etc. So I do find this highly interesting and significant, the fact that, so the amount of foreclosure funds in this space was greater than 50%, all right? With most of this increase in the lis pendens filings occurring the second half of the year. So to me, what that indicates is either delays in the fix and flip project, or the fact of the matter is you've overbought, which means you can't sell your home for what you're looking for to cash out, so you're holding it, and now your loans are coming due, which means you can't move the property, you're not paying your loan, so it's falling into a foreclosure status. So that to me is another telltale sign that that there's more blood in the water with respect to this real estate investment activity on the home flipping side. And to note also, the first 2 months of 2020 shows a further 30% or greater increase in lis pendens over funds in 2019. So we know that the overall year has increased, and we're already seeing that for the first couple months of 2020, comparatively speaking, it's over 30% as well too from last year. So that's significant. So again, to me, when we talk about housing bubbles and housing crashes, typically as I said, the feet on the street and the sort of flipping investor activity is usually the first indications or lead indicators of larger problems, or it starts the erosion and increases to the problems going on. So this I found very interesting and supports kind of what my position is, that, listen, we're in a housing bubble. The matter is, we're trying to figure out when's it going to crash and how much is it going to crash, all right? But this to me is a sign that stuff's happening. And I can tell you in my marketplace here, And what I'm seeing the past couple of weeks, I see a lot more activity, a lot more homes being available for sale, a lot more movement that's out there. And that doesn't necessarily mean things are bad. I know that a lot of larger investors are normalizing their operations, they're streamlining, they're actually cash hoarding now. So they're selling property that maybe they've got a slew of investments, and their cash on cash return maybe is not great in some certain properties. So what they want, let's sell those, get our cash, because we know what's going to happen in the near future, and we're going to see a lot more activity happening. They're going to want to buy. So a lot of these people are hoarding cash at this point in time. So just very interesting to note this. Other information on flipping here is that home flipping rates are up in 64% of local markets. The largest annual increases in some of these markets are Laredo, Texas, up over 100%, Raleigh, North Carolina, almost 60%, Charlotte, North Carolina, 44%, Fort Smith, Arkansas, up 43%, and Columbus, Georgia, up 40%. So these are metros with 200,000 people or above. When we take a look at the larger locations, like that have 1 million and above population, Atlanta's up almost 40%, San Antonio's up 37%, and Tucson, Arizona is up 34%. So flipping activity is increasing in many locations across the nation. Where we've seen some decreases in the larger cities are Seattle, Washington, down almost 17%, Indianapolis, down 9%, Grand Rapids, Michigan, down 8%, Rochester, down almost 6%, Baltimore, down almost 5%. So certain markets either are oversaturated, or for whatever reason, there's some growth or value issues going on there, and the amount of flipping is just not as attractive in certain marketplaces. That will be reflected in this report. Now, home flips purchased with financing dips, while those bought with cash climb. So it looks like we see a little more resurgence in the cash. It sort of was the other way before. So we've seen a decrease in financing and an increase in cash buyers. All right. So just trends, I guess you could say. More flips purchased with financing was in Virginia Beach, Virginia, 67%. Seattle had almost 56%. San Diego, 53%. Boston, 53%. San Francisco, almost 53%. So in certain locations where, to me, this tends to be more expensive locations, more people are using they're using financing to flip as opposed to their own cash. Typical home, this is interesting. Typical home flipping returns drop closer to post-recession lows. So just keep that in mind. It looks like, and we have a visitor. We haven't had our visitor here for a little while here. This is our famous bubble kitty. I've moved my studio locations. This is the first time she's checking it out right now. So there she is. She's not a kitty anymore. So anyway, there you go. Not that interesting. See you later. So I just find that some of this is interesting. And as I said, we see trends going on right now. To further into the report, sometimes they produce 2 articles in the report here. We just find that, again, millennials and baby boomers, more and more people are buying flipped homes, okay? FHA purchasers are increasing just because of the nature of the business. If there's a lack of inventory and flippers are putting out product, when I mean product, I mean homes that have been rehabbed and are nice homes, you're going to get your share of buyers as well too. So a lot of flippers are supplying that marketplace, which wasn't really there before. Now, to kind of put everything in perspective here, here's where homeowners are staying put the longest. And ultimately, I think it doesn't surprise anybody that the warmer the weather, the more often people move, the study shows. This was a Lending Tree put out a study recently about where people are staying put the longest and where people are staying put the shortest time. And it seems to be that warmer states move more frequently, and coincidentally, it actually correlates with the spring home buying trend. And there is a direct correlation between housing price, I guess you could say, housing price increase, so your equity increase versus lack of equity increase, all right? So home values in metros with the stayed the longest were New York City, Pittsburgh, Philadelphia, Buffalo, New York, and Hartford, Connecticut. And it boils down to the home value appreciation tended to be lower or on the lower end of the scale, or metros where they stayed the shortest were Las Vegas, Phoenix, Austin, Texas, Denver, Colorado, and Orlando, Florida. So we certainly see, if I take a look at the values here, for example, They just said that the 3-year home appreciation in Vegas was 39.8%. So guess what? I can buy, I can sell, I'm going to move. All right, why? Because I made some money in my house. Whereas, in Hartford, Connecticut, the 3-year home value appreciation was 0.7%. So guess what? I'm only going to move if I have to for job, relocation, family issues, or whatever. So it's obviously proved out that when you got these locations, they tend to move on. Phoenix, Austin, and Vegas, people tend to move on average of 7.5 years. And with respect to the other locations, New York, Pittsburgh, and Philadelphia is 8.6 years. So certainly a correlation between climate and house values and what you can make. So clearly, if you can make some money on your primary residence, and again, from a tax perspective, you have capital gains tax exemptions on your primary residence if you've been in that residence for longer than 2 years. So clearly 3 years is longer than 2 years, and or 7.5 years. I'm sorry, I'm talking about the three-year value there. But 7.5 years either way is longer than 2 years. So there's no tax implications, but you're looking at a spike in the past 3 years of home appreciation, which is going to make you want to move. It's very interesting to say that. Just to tie up a few things here, iBuyer market share rises in 2019, and which shouldn't be any, I guess you could say, shouldn't be any surprise. Redfin, this is according to Redfin, that 1 out of every 100 homes sold during the fourth quarter of 2019 was done through an iBuyer. So it's 1% of the marketplace on average. It's not huge, and iBuyers are not in every metro location. They're not in every, it's not in the top 20, not in every metro location, from the tier 2 and tier 3 cities. iBuyers are going to choose where they're going to deploy, where they see home appreciation, because clearly they want to buy at a certain price, do their work on it, and put it out at a higher value. So it's got to have home price growth to support what they're trying to do. But the iBuyer market shares that were tops last year were Raleigh, North Carolina, followed by the cities of Phoenix, Charlotte, Atlanta, and Houston. So we're talking fairly significant cities. And guess what? Raleigh and Charlotte are considered the South. It's not necessarily cold all the time there. It does have a more warmer climate. Obviously, Atlanta and Phoenix and Houston are in warmer climates. I know Phoenix is almost like iBuyer ground zero. There's a lot of iBuyers there. That's a lot of them test their strategies and test their implementation and do a lot of work there. So it's kind of the sweet spots. These guys are looking for where home growth is they feel is going to appreciate, and they're going to focus on those markets. And you can start seeing more and more iBuyer stuff happening probably in 2020. I don't doubt that at all. And just to tie up and end up here, a lot of stuff has happened over the past few years. So when you have appreciation and low interest rates, there's a lot of buying going on, a lot of investing going on as well too. So I don't talk too much about multifamily here just because it's not in the news that much. The past number of years has been a significant growth in multifamily sales, so people wanting to buy multifamily, but also significant growth in multifamily development. So you've got different places across the country where there's a significant amount of, we'll call them apartment complexes, 3 or 4 story complexes going up. I can drive, within 10 minutes where I live, and I can certainly pick out 1 or 2 in that radius. I drive on some highways, I see more and more being built. Suddenly you'll see maybe a piece of land that sat there for 2 or 3 years doing nothing, and then in 1 week it's cleared, and we've already got the concrete elevators going up, and typically they're frame locations or frame construction with the concrete elevators, at least down where I live. But interesting enough here, New York City multifamily building sales plunge. Basically, there's 2019 saw a 32% drop in the sales of multifamily buildings, and I guess that's an indication that maybe the market is becoming saturated, or to the price points, because again, everybody wants to jump in the game. So when you jump in the game, it's competitive. You're going to pay more per door or per unit for your multifamily. But Manhattan, Brooklyn, the Bronx, and Queens, that's the sort of New York City, we'll call it area. And essentially what happened is the sales volumes have dropped significantly, basically 32%, which shows that I think market saturation. Also shows the fact that I know that there's a lot of developments that is being put on in the marketplace as well too. So what you'll hear is that there's 10,000 units coming on the next 6 months. That's because those the complexes are being completed, and that's more rental accommodation. And again, this is all rental stuff. It's taking care of the rental market. It's not like you're going to go in and buy a multi-unit. It's not like a condo. It basically is they're being developed for rental applications in the rental market. So that is the scoop with respect to that. And basically it said the slowdown in investment sales transactions has been a product of the perfect storm. Rising interest rates, concern about the new rent regulation laws, and fear that the near decade-long bull market has reversed. In New York, the New York area, there is some very, I guess, onerous rent control and rental law changes going on right now. I'm not too sure if all of them are in place, but from what I've read, it seems to be very difficult for landlords to operate in that marketplace. And if you were building your accommodations, back a couple of years ago, and it's coming to completion now, you're going to be caught with some of these new regulations and laws, which is going to hurt probably the profitability of the project and and what you'd hope to do in the future. So just keep that in mind, that again, these are some of the issues that affect on a larger scale. So anyway, having said that, that's it for today. I'll be cranking some more videos out when I got some time. Lots going on down here. I'm promoting, I'll be very clear, I'm promoting turnkey investment strategies. I'm seeing a ton of property coming across my desk all the time. I'm getting calls. I got a call from some contacts saying, hey, we've got 12 properties coming online here in your location. Start taking a look at them. They've got 150 they want to get rid of. A lot of these are duplexes, single family homes. I've got a bank list I'm working on stuff too. So a lot of my business is not looking through retail. It's this off-market stuff. It's getting stuff, either short sales, auctions, bank-owned REOs, wholesale contacts, people who are looking to move property on a larger basis. That's where the action's at. So if you want more information, please drop me a line, send me an email, give me your phone number. We can text and talk. And as well, if you're looking to understand more about the short sale market, the foreclosure market, I've got training for that and I can help you with that as well too. So anyway, thanks everybody. Look forward to next video coming pretty soon. Take care.